Today's episode is sponsored by Raisin UK, a free, easy-to-use platform that helps you make the most of your savings. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft. Diversification is famously the only free lunch in investing. But when asset correlations shift, that meal might come with an unexpected bill. Economic cycles, inflation surprises, and market crises can all rewrite the rules when you least expect it.
So, are bonds still a reliable hedge for equities, or should we be looking somewhere else? And in today's dumb question of the week, can adding an asset with negative expected returns ever be good for your portfolio? All right, let's get into it. So in investing, many people will promise you some kind of secret sauce, like they have the magic ingredient which is going to boost your returns. And spoiler alert, they're usually lying. However, if there is a secret sauce in investing, it could come from clever portfolio construction, where you combine different asset classes in just the right recipe so that the whole is greater than the sum of its parts. Just at a high level, Robin, how is this meant to work?
Well, the metaphor everybody uses is one of cooking, which is that, okay, some things are tasty on their own, but when you combine them, they're even better. For example, salt on its own, absolutely putrid. Or just eating butter, although I have done that in the past, I have to admit.
Why just eating butter?
I just love butter.
My portfolio's just butter.
But if you do combine things in just the right way, then you can make the most amazingly tasty things. And really, it's about balance, what goes together, and what flavours combine well. And similarly, when it comes to portfolio construction, you have to understand how assets behave relative to one another. It's not just a matter of choosing things which have the best returns.
Yeah, I think that's what separates people who are just getting started investing versus people who have a bit more knowledge. Like when you first get started, you say, well, I've got this bucket, I'm going to throw stuff in. Let's just grab the stuff which is meant to gain in value quickly and throw it all in the pot and it'll be great. Whereas when you learn a bit more about it, you know that that's not the way to do it. And you quickly focus on what's called correlation.
And this is why I think it's difficult to do, because you have to understand this mathematical concept. So, nerd alert, this is going to be quite a nerdy episode, which I absolutely love. Michael's looking a little bit unhappy and hesitant about it.
I was crying putting the notes together. I have to tell you.
Let's see if we can win you over anyway. But the point with correlation is very simply, it's just whether things move up and down in price together. So you look at the return relative to the average, you do that for two assets, and the question is the return above average or below average at the same time for two assets? If they both move up and down together in perfect lockstep, then that's a correlation of 1. If they move in opposite directions, then that's a correlation of -1. And if they're uncorrelated, that's a correlation of 0, where the jiggling of one has nothing to do with the jiggling of the other.
And the correlation between any two assets lies on this spectrum somewhere between -1 and 1. So to take an extreme example, if you've got a stock like Google, there's actually two Google stocks, isn't it? And I would expect them to track each other pretty much perfectly, right? So the correlation would be 1 between the two different flavors of Google or Alphabet.
Yes, and often it's the case. If you look at the correlation of the portfolio, you discover that some things are the same, even though the label doesn't say they're the same. And that's the real benefit of correlation, which is that it sees through the branding, through the nonsense, through the narrative, to actually what happens, how an asset behaves. Does this asset behave like that asset? And if it does, that suggests but doesn't prove that they've got the same drivers.
So in that example of the two Google tickers, that's what we might call a perfect positive correlation. And I guess at the other extreme, you might have a stock, and then if you short that stock, that short position is in theory perfectly negatively correlated. So that would be -1.
Exactly. And you can also find that in the futures market, another derivative, where, for example, you could go long the S&P 500 or short the S&P 500, and those two positions would be perfectly negatively correlated. But that would be very unusual to find in the normal kind of Serengeti of beasts in the asset universe that we normally see day to day.
Yeah, those are just extreme examples. And everything else is going to lie somewhere in between them.
Now, when I first started out as a quantitative analyst and I was looking at correlations across asset types, what really jumped out at me was there are blocks of correlation which are particularly strong in equity. So if you look at two equities anywhere in the world, they're very likely to be highly correlated because they're risky assets. When people are scared, they'll sell any risky asset. And then the second group of investments would be safe assets, things like cash or short-term government bonds, which don't tend to move in the same direction as equity. Those would really stand out as being separate.
So at a very high level, you can separate the world into two buckets, risky and safe.
That's the biggest difference, yeah. So that's why you use those two buckets usually if you want to get good diversification. Something in a safe bucket, something in a risky bucket. The risky stuff generates the return, the safe bucket reduces the overall volatility of the portfolio.
Now, I think it's time we got a little bit nerdy. I'm going to let you run with this, Roman, but we've got to mention modern portfolio theory because this is where the idea really comes that this principle of diversification can benefit you as an investor. So the idea here is really you're trying to maximize the risk-adjusted returns of your overall portfolio.
Yeah, and it's quite an intuitive concept. If investment is balancing risk and return, then what you really care about is how many units of return you get for every unit of risk that you've taken to generate it. And if you wanted a measure which looks at good investments in those terms, you'd look at risk-adjusted return. How much return above the risk-free rate do you get divided by the volatility of that excess return? And many assets actually look pretty good on that score. But what looks even better is combinations of assets, because that really does dampen the volatility. And there is a kind of alchemy here, which only works if you have low correlations.
Yeah, I think the holy grail of portfolio construction really is finding those asset classes where there is a strong negative correlation, and ideally where each asset is still giving you a positive return over the long term.
But you've probably seen these risk-return plots where you've got risk on the x-axis, return on the y-axis. You've got two dots, which are the individual assets you're combining, but then you draw a line between them, which kind of bows out to the left. Because if you combine those assets in just the right way, you get a return which is not as high as the best asset, but not far off, and a risk which is lower than either of the two things you've thrown into the bucket. And that's the magic.
The secret sauce. Now, when you put it in those terms, it sounds quite straightforward, doesn't it? We just build a model, we get the correlations between all the different assets, we work out the perfect combination with some mathematical wizardry. Bob's your uncle, perfect portfolio. However, these correlations don't like to behave themselves, and they change over time.
It is annoying. And that means that something which did diversify in the past may not diversify in the future. And it's probably worth mentioning as well that if you're calculating correlation, you're assuming some period of time over which you calculate the returns and for which you calculate the correlations. Is it daily returns? Is it weekly, monthly, annual, decade-long returns? You'll get very different answers depending on what you choose. But there is no perfect calculation of correlation. Each of these gives you a different aspect of the underlying relationships between asset classes.
But I guess even if we did decide on what we're going to use to measure correlation, what our preferred measure of risk-adjusted returns is, because annoyingly, there's different measures of that as well. If correlations didn't change, we could decide on an optimal portfolio. But correlations can and do change, and they change sometimes very abruptly. So I think what we should do is maybe look at how correlations have changed in the past and why that's happened. Should we start with the stock market? Because you said earlier on that any two stocks tend to be very highly correlated. And I guess by extension, any two stock markets are highly correlated. But if you look back through the data, that hasn't always been true.
So let's imagine we go back a century and we consider a Japanese stock trading in Tokyo and we look at a US stock trading in the US. Now, at that point in time, there wouldn't have been that many common drivers of return. Whatever's affecting markets in Japan probably didn't affect markets in the US. Fast forward to today, and you bet those two things would be highly correlated. It's very unusual to find a stock which is not correlated in two different countries nowadays. And you've just got to look at what's been happening in politics recently to see why. The world is more interconnected, and if there's something that goes wrong in one country, it usually spills out into other countries as well, particularly if the source of the volatility is a large country like the US or China.
Yeah, I think it's the era of globalization which really boosted correlations between global stock markets. So if you look back through the historical record, really it kind of kicked off around the 1970s, where the correlations began to creep higher. And they basically went from a situation where there wasn't really a strong correlation between different stock markets to a peak after the global financial crisis when the US and European stock markets had a correlation coefficient of around 0.8, which is pretty close to 1.
Now, we said that equities are highly correlated. There are some equity markets which are less correlated to global ones. And for example, Japan is the one people usually think of here.
And is that because it's had a pretty terrible time when the rest of the world, particularly America, has been doing very well?
I think that's part of it. And I think also the structure of its market is quite unique in the sense that its drivers tend to be idiosyncratic. They're specific to the Japanese market. Another thing about the Japanese market is that the Japanese yen was seen as a safe haven, as was the equity market to some extent. So when equity markets were selling off from the US, during the peak of the global financial crisis, Japan was pretty much seen as a safe haven, a safe place to store your capital away from all this crazy subprime crisis.
And if you look at the data, which comes from Kenneth French, the correlation between American and Japanese equities was actually slightly negative in the years around the financial crisis. It's gone back to positive since then. But it's an interesting example of how correlations shift. And I think what a lot of people say is that the correlation between developed markets generally and emerging markets tends to be less strong than within the developed market bucket.
Yeah, that's usually the case. If you're looking within a country, within a sector, within a region, the correlations tend to be higher.
One thing I noticed when I looked at the data was that this trend of stronger and stronger correlations between different equity markets seems to have actually turned around a bit at the start of the pandemic. So it seems to be the case that if you take any random stock market and look at its average correlation with all the other indices in the world, that has fallen since the start of the pandemic. And it's fallen for every single market, although the effect is quite modest. But it's different to what we've seen in history. Is this because globalization has weakened slightly?
I'm not convinced that's the cause of it. You would expect to see higher correlation during periods when there's a global crisis like the pandemic. And then you'd expect to see markets going their own way. Maybe that's just a result of that enforcement of correlation gradually fading over time. But there is another aspect to this, which is that you can look at the numbers and get completely focused on these numerical measures of correlation and ignore the obvious stuff. For example, if there is an underlying driving factor for a whole market, then it might look like things are uncorrelated, but really they're not. And a classic example was pure alpha funds in 2008 and 2009, when everybody was saying, oh, we generate uncorrelated return, and that's based on our very sophisticated quantitative research. And yet it turned out that many of these hedge funds were following the same strategies. And then when equity markets sold off, they all wound up falling together. And the correlation that was supposedly 0 turned out to be 1. So sometimes you've got to use your common sense and maybe zoom out from the numbers and think, is there an underlying common driver here? If you're looking to make your money work harder, check out Raisin UK, the simple, no-fee savings platform. Access exclusive accounts from FSCS-protected banks and manage everything with one login. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft.
Okay, so we've spent a bit of time discussing correlations within the global stock market. And it's probably not that surprising that within an asset class, things tend to be positively correlated to a greater or lesser extent. But the key to modern portfolio theory and the construction of a portfolio with good risk-adjusted return is combining different asset classes. And here, the traditional place to start would be the correlation between stocks and bonds, which many people have seen as a good way to diversify a portfolio. I mean, that's where the idea of the 60-40 blended portfolio comes from.
Yeah, that's really been the bread and butter of investment strategy going back many, many years now, decades. But the underlying assumption here is that the drivers of bonds and stocks are different, and that's why they're uncorrelated. Now, the reason why bonds and stocks tend to go in different directions is that while equity feeds on economic growth and good news, bonds thrive on bad news for the economy. So when there's a recession announced, what we see is that bond prices tend to go up, whereas equity prices tend to go down. Conversely, when there's good news, things go in the opposite direction. So that's the fundamental reason why many people think that bonds and stocks should diversify one another, theoretically.
I mean, I got into investing in the kind of mid to late 2000s, and it was just taken as read that this was the truth, right? Stocks and bonds diversify each other. 60-40 is a reasonable portfolio construction. It's going to be a decent hedge in bad times. But then 2022 happened, right? And a lot of people realized that this conventional wisdom wasn't always true.
And the thing to realise is there was a sense of recency bias, and there had been a very long period when inflation was reasonable and not particularly high. What happened in 2022, of course, was that inflation was no longer reasonable. We had a huge spike. And of course, inflation is toxic for equity as well as bonds. And that meant that both of them fell together. In fact, if you do look at historic correlations between equity and bonds, the periods when the hedge breaks down are those periods when inflation is particularly high.
And the problem in 2022 was inflation was very high, and central banks around the world responded by tightening monetary policy and hiking interest rates, which, as you say, neither stocks nor bonds like. And what people had assumed to be this relatively stable negative correlation between stocks and bonds flipped sharply positive to levels not seen in decades. And the diversification benefits that people had come to rely on basically disappeared overnight. And the traditional 60-40 portfolio had the worst year of returns since the financial crisis. And in fact, 2022 was the only year in the past 45 years where both US equities and US bonds lost value.
Now, there is a caveat here, which is when we're talking about bonds, of course, they come with different durations. So if you just go for a grab bag of almost every corporate investment grade bond, every government bond, which is what you get with these global aggregate indices, sure, they sold off at the same time as equity in 2022. However, if you'd have gone for shorter duration government bonds, which are more cash-like, they held up pretty well. So while it is true that if you have a lot of duration in your bond allocation, it can break down this negative correlation, what isn't the case is that cash or cash-like investments like money market funds, short duration government bonds would also fall at the same time as equity. That would be absolutely flabbergasting.
Yeah, when people are talking about the traditional 60-40 portfolio, typically the 40, the bond component, is thought to be intermediate US treasuries, like 10-year government bonds.
So the duration would be about 7 years, something like that. It would be the belly of the curve you're looking at. Whereas if you're looking at a money market fund, the duration is a quarter of a year or less. So that's a very different beast from a bond portfolio, which has got 7 years duration, say.
But as someone who's a little bit younger than you and sort of believed what they were told about stocks and bonds and the correlation, maybe I wasn't so aware of the historical record. And I just took it as a fact that typically stocks and bonds diversify each other. But when you look at the historical record going back decades, you could make the case that this negative correlation, the hedging property of bonds versus stocks, is actually a bit of a historical anomaly rather than the norm.
It depends on the window you look at. So, for example, we had a period when inflation was very high during the 70s and 80s. And during that period, of course, the correlation was largely positive, not huge, somewhere around 25% or 0.25. And of course, it can spike during the short-term moves in both markets. But if you go beyond that and go before 1970, again, there was a period when they did diversify one another. So really, that's the big driver, is inflation high. That can be one of the drivers, which can make both fall together.
To be honest, it seems a bit of a coin flip. If you look at some of the data going all the way back to 1875, across all different kinds of macroeconomic periods, stocks and bonds have been positively correlated just a little bit more often than they've been negatively correlated, apparently, if you believe the data.
What you're really looking for here is low correlation or zero correlation, because that gives you a diversification benefit. So a small positive correlation is something you could probably live with. It'll still give you the diversification benefit. It's when it gets up to about 0.3, 0.4, 0.5 when it becomes a problem.
And you made an interesting point a little while earlier, which was around the duration of the bonds you're holding. Because as we said, people are typically diversified with 10-year treasuries or equivalents. Whereas if you go back prior to the 2000s and look at what would be the best diversifier for an equity portfolio, it was actually more likely to be cash or short duration bonds rather than these longer dated ones.
Yeah, cash is a great one because it doesn't crash, or money market funds, which are very cash-like, or ultra short duration government bond funds, again, cash-like. And they behave very interestingly. If inflation's high, they tend to pick up the higher inflation rate pretty quickly. So they don't necessarily offer a huge negative real return, which is what people assume if you're in cash is what you get. Of course, cash under the mattress will have a negative real return, but if you invested in short-term debt instruments, they will adjust to the higher inflation rate quite quickly and generate maybe not a huge positive real return, but usually something which tracks inflation at least.
So if we drill into this correlation between equity markets and longer dated government bonds, as we've said, that can flip positive or negative throughout history. And to some degree, it does seem to correlate with inflation, like you said, and economic cycles. Now, in very broad terms, I'd suggest it's possible to group up macroeconomic regimes into 4 buckets, which is the biggest driver of the stock-bond correlation.
So macro investing at its core is 2 variables. One of them is inflation, the other one is growth. And when growth is okay and inflation's pretty low but positive, that's the Goldilocks zone. When things just bob along, things don't crash, bonds and equity have a negative or small correlation, and everything's peachy.
So in that environment of reasonable growth and low inflation, stocks like the growth, whereas bonds are maybe a little bit wary that interest rates could tick up. And when you get shocks, they do what we expect them to do, and they hedge each other.
Another regime which people think about is when the economy is overheating. So growth is high, inflation's high, and people are probably getting a little bit concerned. Maybe the equity market's a bit jumpy. Now, of course, in this kind of situation, the central bank will be getting cautious and raising interest rates to try and stave off inflation. And that often causes an overheating stock market to crash. That has happened many, many times in the past.
And I think the key thing from a correlation point of view is in this overheating economy situation of high growth and high inflation, typically stock-bond correlation will be positive, like they won't be hedging each other.
I think it depends on how high the inflation gets. If it's just reasonable, I'd say the correlation would still work. If it gets super high, as we saw in 2022, then clearly that's a problem, and the negative correlation would break down.
I was reading various analysts' opinions ahead of this episode, and there seems to be a bit of a debate about what matters here in terms of the correlation. Is it the level of inflation? Like you could say, oh, if it gets above 5%, that's really bad news. The correlation between stocks and bonds is going to go positive, the hedge is broken. Or is it the speed of change of inflation? Like rising inflation is the thing that's bad. Or, third option, is it a surprise? Like it's not so bad if markets expect inflation to be high, but when it comes along out of nowhere, that's what's really bad.
I think surprise is definitely bad, because if the central bank didn't see it and it's a shock, then they're probably going to act very aggressively. And that's never good for markets. You get a big repricing. And I think another thing here, which is really important, is the source of the inflation. There are different reasons why inflation can spike. Some of them are seen to be good, some of them are seen to be bad. If we've got demand pull inflation, Like in the UK, for example, in the 80s, we had a big surge in the finance industry. People got paid more, at least in certain industries like finance, and that drove prices up. Now, that would be seen almost as good inflation, if inflation can be described as good.
We've got more money than we know what to do with, right? And we're all bidding for the same goods, so the price goes up.
So people with spare cash would have bid up the price of Rubik's Cubes, shoulder pads, and Walkmans, and that would have increased the inflation basket prices too.
Sounds like you had a great decade in the 80s, Romy.
I must say, those trends left me behind. Although I did like my Walkman.
Okay, so maybe that's good inflation. I'm not sure if it is, but what's worse inflation?
Well, that's when you have a supply shock. That means that people still have a demand for goods and services, but supply chains and shops can't supply the demand for those goods. And that means the prices of those goods increase. We saw this after the pandemic when many supply chains broke down and prices increased as a result.
So are you saying that this bad inflation, supply shock driven inflation, is more likely to push the stock bond correlation positive, take away the hedging property?
Yeah, that's right. Another one which is often caused this kind of inflation would be oil prices surging. This is what happened in the 70s when we had various supply shocks out of the Middle East, often to do with wars in the Middle East and geopolitical uncertainty in the Middle East. But whatever the cause of the supply shock, this is seen to be more toxic, I'd say, than demand pull.
So out of the 4 macroeconomic scenarios, we've covered the 2 with high growth, Goldilocks and overheating. Let's turn to the low growth scenarios. So what maybe leads on from the oil shock is stagflation, where you've got low growth, but at the same time, you've got toxic and high inflation. This is the situation in the 70s, right?
And it was awful because the central bank can do very little because its dual mandate is pulling in opposite directions. And for consumers too, you're in a situation where growth is low, you've got very little job security, prices are rising, so it's very difficult to match your increasing outgoings with an increasing salary.
And I think it's pretty clear that in a stagflationary scenario, that hurts both stocks and bonds quite badly. And the correlation is positive. It's not going to hedge your portfolio.
That's right. So that's another toxic environment when it comes to the bond equity hedge.
And to just round out our 101 guide to macroeconomics, the 4th situation would be recession, where you've got low growth and low inflation.
Yeah, or outright negative growth. That's the way people usually think of it. So, for example, in the UK, it's 2 successive quarters of negative growth. Now, this is an environment where bonds really will help you. Typically, when growth is low or negative, that's when bonds rally. Remember, we said earlier that bonds feed on bad economic news. What we tend to see is that yields at the long end of the curve are driven by growth and inflation expectations. And as those fall, yields fall and prices rise for bonds. So bonds like misery, whereas equity clearly doesn't. And so that's one scenario where bonds are actually pretty helpful.
So it sounds like of the 4 scenarios, we've got 2 where the correlation is negative and helpful, and 2 when it's not so helpful. If there's a recession, or if there's this kind of Goldilocks growth, bonds are going to do their job. Whereas if we've got an overheating economy or stagflation, they might not save you.
But I'd say there's a kind of 5th scenario where we have a huge shock to markets. And it could be from something like a pandemic, or it could be financial, it could be military. And all of these correlations we've been talking about, where you look at the daily returns and you look at whether they're positively or negatively correlated over short periods of time, all of that can go out of the window depending on the nature of the shock. So, for example, a tariff shock, a global tariff shock, is going to be toxic for bonds in the US and for equity in the US at the same time. Another one might be a pandemic, where you've got essentially the economy being switched off and on again. That's a huge synchronized shock globally.
I've heard this scenario referred to as correlation breakdown, where the diversification properties you treasured so dearly just desert you at the worst possible time. And some people say that in a crisis, correlations can go to 1 across a lot of different asset classes. Like if there's panic and people are just selling indiscriminately or being forced to sell because there's margin calls, you get contagion between assets. And at least for a short period of time, diversification can be kind of non-existent.
Now, there are some asset classes which, even in this kind of scenario, do okay. Cash, for example, or cash-like investments can be a really good safeguard against this kind of crisis. Gold is another one, which is an extreme tail risk hedge, and certain derivatives. So if you have put options, which are expensive to roll over under normal conditions, but in these kind of scenarios, they can be useful.
And then there are some assets which are sometimes a good safe haven hedge and sometimes less so. The obvious one being these longer duration treasuries, where in the global financial crisis, for example, when equity markets panicked and sold off dramatically, treasuries were a very, very good hedge.
Yeah, they rallied hugely. And the longer the duration, the better the rally. But during that period, what we saw was a huge number of asset classes, the risky ones, have a correlation which very rapidly approached 1 for a brief period of time. And then if you compare risky and non-risky assets, so that would be government bonds, gold, and money market funds, all of those would have had a negative correlation with equity. So what we saw was an extreme shift in terms of correlation to +1 or -1, depending on whether the asset's in the risky bucket or the safe bucket.
What were the assets in the risky bucket that all suddenly had very strong correlation?
Well, the obvious ones, like equity, anywhere, there was no safe haven really. Japan did provide a bit of safety, but even there, stock market sold off. Other risky assets would have been things like real estate investment trusts, which essentially buy pooled access to property.
Yeah, that wasn't where you wanted to be in 2008.
It was atrocious. High yield credit, junk bonds, those sold off too. In the currency space, you saw risky currencies sell off. So, for example, commodity currencies such as the Canadian dollar, the Australian dollar, and of course, commodities fell too.
Now, you mentioned there that high yield credit, what some people would call junk bonds, sold off massively in the global financial crisis. But investment grade credit also sold off, just to a lesser extent, right? They wouldn't have hedged you so well as treasuries.
Yeah, funds like LQD, which gives you IG credit, investment grade credit exposure in the US, would have fallen by about 20% peak to trough, whereas high yield credit would have fallen about 40%. And equity, of course, fell even further, more than 50%.
But if we step away from crises and just talk about constructing a portfolio, we've talked about stocks, we've talked about bonds, but there are obviously other asset classes which people mix in there because they feel it gives them a diversification benefit. For example, commodities. How are they correlated with stocks, bonds, and other assets?
Commodities are interesting because it's such a diverse asset type. For example, gold would be included in that space, but it is seen as a safe haven. So when everything's selling off, gold would hold up well during these periods of recession and crises where there's lots of fear. However, if you look at other commodities, things like industrial metals, those depend very much on growth. Copper is seen as a proxy for growth in China, for example, which has got very copper-intensive growth. Oil is seen as something which feeds off economic activity, so if there's a weakening of global economic activity, the oil price plummets. So by buying a basket of commodities, the real questions are, what's the composition of the basket? How much is in oil? Usually that dominates. How much is in the safer stuff? Are there agricultural commodities in there? Because those are really unpredictable. They're driven by disease, weather, all sorts of very odd things.
Yeah, that's a really interesting point, and I think gets to the heart of why commodities might be a good diversifier, is because they're called real assets, aren't they? Their value is not tied to future cash flows as such, like with financial assets, like stocks and bonds. Real assets, like commodities, are driven by supply and demand dynamics in the real world.
Yeah, and as someone who's of Iranian descent, I've got to say at the moment, I've been badly burnt by the demand for pistachios because everybody's trying to buy this Dubai chocolate. It's bid up the price of pistachios. And for someone who's heavily addicted to pistachios, that's a massive problem in the Nakisa household.
Well, at least you're not addicted to coffee like me, because that has also spiked. We need to diversify our tastes, Romin.
But I've got to say the Dubai chocolate was pretty nice.
I've not tried it yet. Just the branding puts me off. But looking at commodities broadly, and maybe excluding gold here, maybe if we put gold to one side, everything else, the historical record shows inconsistent correlation, I would say, with other assets. Maybe you could characterize it as being low or slightly negatively correlated with bonds and a modest positive correlation with stocks. But really, it seems that people hold a commodity basket because they think it protects them from very sharp inflation surprises.
I'd take it a bit further than that, and I'd say it provides you with some protection against geopolitical shocks because, for example, there was a period in the past where wheat prices shot up in the 70s due to an embargo on corn. Now, who could have predicted that? It was completely unpredictable. But if you'd have had broad commodity exposure, at least you'd have had a bit of upside exposure to that. The one people always talk about is oil. And again, it's unpredictable, it spikes, it causes equities to fall, usually. You can never predict the timing of it. And then when things are normal, the other good thing about commodities is they tend to track inflation. So you wouldn't expect a huge positive real return above inflation long term, but you do expect commodities to track inflation.
But crucially, from the point of view of this episode, correlations are low with the rest of your portfolio, probably. So some people make the case that you should hold a small amount of commodities in addition to stocks and bonds. And that will improve risk-adjusted return if you get the mix right.
Yeah, just not too much commodities, maybe a fifth. Certainly it's worth looking at and doing some back tests to figure out what kind of allocation you want. And probably it's best to separate out gold from broad commodities because those two behave very differently.
Yeah. And again, the correlations change. So I've seen the argument that following the financial crisis, there was a phenomenon termed the financialization of commodities, where new products were being launched, exchange-traded commodity funds, and there was a huge amount of money that flowed into them. In fact, so much that commodity prices were being driven more by investor flows and portfolio allocation decisions rather than those physical supply and demand factors. And the consequence of that, in terms of correlation, was that it increased, though that does seem to have subsided again in recent years.
Now, there's a whole industry of alternative investments where people try to find this holy grail of uncorrelated returns. And people might look at things like real estate. They might look at private equity, where the volatility, some people say, is laundered. So you don't actually see it. And that includes the correlation. If you don't observe the price changes, well, maybe they don't exist.
So the claim is that private equity fund managers don't update the NAV, the net asset value of their fund, either frequently enough or accurately enough for you to know what the real true value is at any one time.
Sometimes justifiably, I think, because certain investments you can't price because they're not traded on public markets, which by definition is true for private investments. But they do tend to behave as an uncorrelated investment as a result of that. Another one might be managed futures, where fund managers can go long or short based on any trend, up or down. That tends to be uncorrelated with broader markets. And of course, cash. Cash is the one which historically has certainly worked, unless there's a period of really, really, really high inflation, hyperinflation as it's called. But in the West, that hasn't happened for about a century now.
But the fact there's all these alternative investments people pursue suggests that there is real value if you can find an uncorrelated asset, which is reliably uncorrelated. But it's easier said than done, I guess. And the question here is, where will correlations go next in the years ahead? Do we know? Can we know?
Again, it's like equity return. You can't predict what it's going to be in the future. All you can really look at is the reasonable state of the drivers which produce asset returns. Now, if it is the case that we see a breakdown in globalization, then actually that would reduce correlation globally. As we saw in the past, if you go back in time, rewind the clock, asset correlations were lower because economies weren't so intertwined. However, I think that's unlikely to happen. I think once you've gone down this route of globalization, it's very difficult to backpedal.
And the other point really is that just because something has a low correlation with your portfolio or a negative correlation doesn't necessarily mean it's a good asset to purchase, right? There's other considerations here, like the volatility of it, its long-term return, and the cost of holding it.
And it may be that you just don't want exposure to that asset class. Private equity, private credit are two examples where perhaps you don't want the illiquidity of that investment. It's illiquid but uncorrelated, and that combination may not be up your street.
And modern portfolio theory, as I understand it, relies on rebalancing. So illiquidity might prevent you from doing that.
Yeah, that's right. It does. And I think it is just a theoretical construct, modern portfolio theory. And I wouldn't pay too much attention to the details, just the broad outlines of what you learn from it.
But if you are going down the route of building a portfolio that should be less volatile than 100% stocks, for example, maybe this is a good place to start, trying to understand how assets interact with each other and what the upshot of that would be. Remember, the whole can be greater or less than the sum of the parts.
Now, if you do join our membership, one of the things we often discuss is those correlations between assets, and we have tools to help you calculate that. If you want to learn more about that, just go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, can adding an asset with negative expected returns ever be good for your portfolio?
Now, negative expected return is what you'd really hate to have in any asset, because what it means is that you're losing money over time. And there are lots of investments like this. If you have a futures position and you're rolling it, often you get a negative carry. You're buying when it's expensive, you're selling when it's cheap, and that way you're exposing yourself to that market, but paying a price to do so. And that's called a negative carry.
But the fact that these assets exist presumably suggests that there are reasons to hold them, even if they're going to lose you money on their own over the long term.
That's right, and the commodity exposure we discussed earlier is one example where you can only get exposure via futures with this negative roll cost. You can do certain things to minimize the roll cost, but it's never completely removed. But the reason why we like it is because it does have this really nice property of reducing the portfolio the volatility.
But just because it reduces volatility doesn't mean that's a net positive for you, unless that reduction in risk is proportionally larger than the reduction in expected return. So it's going to hurt your return, but as long as it lowers the risk by more.
And you might be thinking, how could it possibly do that? Well, one way is if you imagine that equities fall 50% in a crash. If you do have investments which have protected you on the downside, that'll cushion your losses and potentially increase your long-term return.
I mean, all else being equal, you'd rather all your assets in the portfolio have positive expected returns and are actually helping you on their own. So the ideal diversifier is a combination of low or negative correlation alongside reasonable returns. But that doesn't mean something that has a small negative expected return can't help you, if you see what I mean.
Yeah, and this is why things like buying protective puts is a strategy that many investors use, because eventually they're going to have a scenario where it's going to protect them on the downside. There is a cost with that because you have to pay for the put options, they keep on expiring, you have to buy new ones.
Is this a little bit like saying there is value in insuring your home, even if you never get a fire, right? Your expected overall financial position through all possible futures is improved if you don't lose everything if you leave the stove on.
Yeah, I think that's part of it. I think another way of looking at it is to think, okay, over the long term, you'll be fine if you just buy equity. But if you've got a finite investment horizon, then this kind of diversification can really help you if you need that money in some period of time, which is less than 100 years.
And even if your time horizon is infinite, if you can get the risk-adjusted return up and you have access to cheap, unconstrained leverage, then theoretically it would help you, right?
Yeah, many people have pointed this out. If you lever up this diversified portfolio, you can actually do better than buying the individual assets themselves.
You know, I'd be so worried that the correlations break, though. I need it, and my levered up portfolio suddenly costs me everything. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.